Hey, if you've got a microphone on your computer, you can visit yourmoneyyourwealth.com. Scroll down and click Ask Joe and Al on air. You click the button and hit record, and boom, just like Jack did from Atlanta.
Hello. I'm trying to figure out the best way to simplify my portfolio. For years, I've been investing monthly into a number of mutual funds and taxable accounts at 4 different institutions. Now I want to combine it all under one fund before I retire early next year. How can I do this and avoid a high tax bill on capital gains? This is Jack from Atlanta, by the way. Thanks.
All right. Jack, thank you for doing that. Again, go to yourmoneyyourwealth.com and scroll down, click on the button. See, this is a lot of fun.
It is a lot of fun.
What? All right, so he's trying to consolidate, it sounds like.
Right. He's got 4 different institutions, so that's like different custodians.
So he's got an account at maybe Fidelity, TD Ameritrade, Merrill Lynch,
Sure,
Vanguard,
whatever.
And
right.
he's like, okay, well, I'm getting all these statements. I'm looking to retire. I want to simplify my life. How do I go about doing this to avoid capital gains?
Right.
Well, I got a first thought here. You can always consolidate your investments and not incur any type of capital gain.
Right.
So let's say you want to hold all of your money at, I don't know, Charles Schwab, right? Charles Schwab is not paying me for this.
Are you sure?
Yes. Chuck and I go way back.
Okay.
All you need to do is just do a transfer. You can transfer all these different accounts, and you can consolidate all of your investments under one roof if you choose to.
So that would make it much simpler. Instead of 4 statements every month, you have 1 statement from Charles Schwab. And so you, like you say, you don't sell the assets, you just transfer.
In kind.
In kind, right? So it goes over in kind. The investment you had at Fidelity, you still have at Charles Schwab. There was no sale, there is no tax consequence.
A lot of times people think that is diversification.
Right. Different custodians. I got 200,000 here. I got 300 there. I got 50,000 here. I got $10 over here. You know, I'm diversified. Yeah.
Well, no, not. I mean, sure, but you don't necessarily. When you're looking at securities, right? You are an owner of that particular company. People, I think, might get confused with CDs. Yes, if you have millions of dollars and you want to buy FDIC insured CDs, then you have to use several different institutions.
Right. That is true.
Not with securities, because Charles Schwab is like a grocery store. Charles Schwab and Fidelity, let's say you got Albertsons versus Kroger.
Okay.
Okay,
good for you.
Pretty good, huh?
Yeah, right.
I go grocery shopping a lot.
Do you get payouts from
And
them
there's actually
too?
Kroger in Atlanta, so there you go.
Right? And then there's Bonds.
Yeah.
Right?
Yeah, I thought you would have said Vons and Ralph's. Those are the common ones here.
Got it. Okay.
Yeah.
Or Hy-Vee.
Hy-Vee?
I think that's one.
Okay.
So you go to that grocery store. You could buy beans at all of those grocery stores for the same price, roughly, right?
And that's usually what you buy first. Does Ralph's or Vons have better selection of beans?
Right? Or bananas or whatever, If you want frozen chicken, you can just go there, right? And all of those stores will have it.
They got the same stuff.
Right? So if I want to buy Apple stock, I can buy that Apple stock through Fidelity, through TD Ameritrade, through Charles Schwab, through E-Trade, through whatever.
So I can buy a can of beans at Ralph's and Vons.
Yes.
And that's not diversification.
Right. So if I'm running to Ralph's and then buy 1 can of beans and then I'm like, I need another can, but I can't buy 2 cans here.
Yeah, they're not allowed.
I got to go to Ralph's. Or Vons, whatever. So, but what I'm saying is that, all right, you go to the supermarket and then you buy all of your stuff at that one supermarket. It's very simple. It's very easy.
Right.
Well, same with your investments. You can go to one place to buy all of those different, like Charles Schwab doesn't necessarily have more options for you than a Fidelity.
Right.
Is my point.
Agreed.
Right.
So the other thing that you can do, so now you'll end up with a bunch of different investments inside, to use your example, Charles Schwab. And so, and maybe you don't want that many investments, or maybe they're not the best investments for you going forward.
Right. So now then you're looking at selling, then that's where the capital gains come in.
That's where the capital gains come in. And what I like to do in a case like that is look investment by investment and look at the amount of gains in each investment relative to the investment itself. And then I come up with a gain percentage. Like if you bought Apple stock, let's just say you had the fortune to buy that 10 years ago, it might have gone up 5 times. or whatever. So that'd be a tough one to sell from a tax standpoint. It might be the right thing to sell from an asset diversification standpoint, but from a tax standpoint. So if you're just thinking taxes, that would be at the bottom of the list. On the other hand, you might have an S&P 500 fund that you bought at the beginning of last year and it's actually down. So you could sell that one. You actually create a tax loss that would allow you to sell some other stuff. So you just kind of rank these investments and then come up with a strategy on how to gradually sort of get this reallocated without paying a ton of tax.
So put it this way, get a spreadsheet, name your investments on the one column of your spreadsheet.
Correct.
Okay. And then the second column of the spreadsheet, I would put market value.
Correct.
So if I bought Apple, it's worth $100,000. Then the next column, what you would want to put down is cost basis, what you purchased it for. So my first is what the investment is, Apple. Second column is going to be market value, $100,000, and then my cost basis, let's say it's $50,000. Then on the third column, it's going to say gain or loss. In that particular example, I have a $50,000 gain. So you want to do that with all of your investments. Just put it together, a simple spreadsheet, put the name of the investment, the market value, the cost basis, and then gain or loss. And then what, Al, I think is what you're saying, is just rank those to the lowest to the highest, right? So you could probably diversify. Maybe you had 50 different investments, right? But maybe you could diversify out of 30 of them, and then your full gain on all those 30 investments might be only $20,000.
Yeah, or it could,
versus if you did everything, it could be $150,000.
Right, or it could be zero.
Right.
If you have some positions that are in a loss and you net that with other positions where you don't have a lot of gain in them, but it's a lot of proceeds. So anyway, that's really how you look at it, and I'm proud of you. That's an accountant's answer.
Yeah.
Here, let's get a spreadsheet.
Right.
Here's column 1. Here's column 2.
But I think that would help someone quite a bit, because that's what we do when we look at this. Is like, okay, well, what is the most that we can diversify out with the least amount of tax?
Yeah, and then the next thing we do, once we've done that, it's like, all right, now let's look at your tax bracket. Like if you're in the lowest tax bracket, call it the 10 or 12% bracket, your capital gains are taxed at 0. So maybe you can accommodate another $40,000 of gains, still stay in that low bracket, and pay 0 taxes, at least 0 federal taxes. You'll still have to pay state taxes probably.
So just some things that you can use there to help you. But another piece of advice, Jack from Atlanta, is it's the beginning of the year. And I would more or less worry more about the diversification. Don't let the tax dog shake the tail.
Yeah, you always ask me, I always forget, but that's right.
Whatever.
Don't let the tail wag the dog.
Don't let the
Is that what it
the
is?
tax
Tail wag the dog.
wag the investment dog.
There you go.
That sounds weird.
That sounds bad. I don't think that's right. Anyway, so it's the beginning of the year. I would look at, okay, well, now I did my spreadsheet. I see what the total gain is. I probably would want to diversify out to have the right portfolio for me. Now that it sounds like you're transitioning into an early retirement next year, you want to make sure that you have the right portfolio put in place. Then you want to tax manage the heck out of that account because stocks are volatile. And this sounds like you're in a brokerage account because you're worried about capital gains. You could tax loss harvest along the way, and then that would offset any gain. You have, the next 12 months to tax manage the overall account because your full gain or loss is not going to be totally calculated until December 31st.
Yeah, I think that's exactly right. Investments are more important. The right investments for you are more important than the taxes. You always consider taxes, but that's not really the first thing you look at. Hey,
we got to take another short break. But if you want, again, go to our website. If you want to be like Jack from Atlanta, and you got a microphone on your computer, you can visit yourmoneyyourwealth.com, scroll down, and click Ask Joe and Al on the air, and then hit record. Or if you don't have a microphone,
yeah, you could do it right on your phone.
We should test that out.
Yeah,
well, I was going to say there's another thing there that you can just click and send a message, and you can actually type it in.
You can just type it in.
That's what you're going to say.
Because some people get maybe nervous.
Yeah, they don't want to, because we're going to put your voice on air.
Yeah. And we will not pay you a royalty.
That's one thing we know for sure.